Hello and welcome. Today, we're tackling a subject that honestly gives a lot of people in the UK a major headache: capital gains tax. It can be super confusing, right? Well, to help us all get a clearer picture, the experts over at ProTax Accountant have arranged this discussion, and we're going to break down exactly when you need to pay it and, just as importantly, how to get it right. All right, let's just dive straight in. There's a reason this topic is suddenly on everyone's radar. As one expert put it, capital gains tax has been making headlines for all the wrong reasons lately. And you know what? That's not an exaggeration at all. Because of some pretty big changes, this tax is now affecting way more people than it ever used to.
So what's the big deal? Well, here's the main reason right here. The amount you can make tax-free each year, your annual allowance, has been absolutely slashed. I mean, just a few years back, it was a pretty generous £12,300. But for this coming 2025 to 26 tax year, it's plummeted to just £3,000. That is a huge, huge drop. And what that means for you is that even profits that seem pretty small can suddenly land you with an unexpected tax bill. Ouch.
Okay, so here's our game plan for today. We're going to look at why this tax is catching so many people out, what actually triggers it, the two different ways you have to report it, which is a big one, how to figure out what you owe, some really common and costly mistakes to steer clear of, and then we'll finish with some smart planning and expert help. Sound good? Let's get into it.
All right, first up, the unexpected tax bill. Let's dig into why those smaller profits are suddenly causing such a big problem.
So, let's talk numbers. These are the rates we're looking at for the 2025 to 26 tax year. Now, the interesting thing is, the rate you pay depends on your income tax band. So if you're a basic rate taxpayer, you're looking at 10% on most things, like shares or crypto. But for residential property, it's higher, at 18%. And if you're a higher or additional rate taxpayer, those numbers jump up to 20% for most assets and a pretty steep 24% for property. The key takeaway here is that your total income for the year is absolutely crucial in figuring out your final CGT bill.
Okay, moving on. What actually triggers capital gains tax? You might think it's just about selling something for cash, but believe me, it's a lot broader than that.
The magic word, or maybe the scary word that HMRC uses, is disposal. And a disposal isn't just selling something, it covers any events that can trigger this tax. So yeah, selling is one, but so is gifting an asset to someone, unless it's your spouse or civil partner, or swapping it for something else. Even getting compensation from an insurance company can count. The really crucial thing to get your head around is that a tax bill can be triggered even if no cash actually changes hands. That's a big one.
So, what are we talking about in the real world? Well, here are some of the most common things that'll trigger a CGT bill. We've got shares, unit trusts, and bonds that aren't tucked away in a tax-free ISA. Of course, there are buy-to-let properties and second homes. Crypto is a huge one now, things like Bitcoin, whenever you sell it, swap it, or even spend it. Then there are valuable personal items, like art or antiques if they're worth more than $6,000. And finally, a big one for entrepreneurs, selling your business or its assets.
Okay, now we're getting to what is probably the single biggest point of confusion for taxpayers: the two different paths to reporting. And honestly, getting this wrong can be a really costly mistake.
Just look at this. It really lays out the two completely separate systems. On one hand, for UK residential property, you are on a very tight leash. You've got just 60 days from completion to report and pay the tax online. 60 days! But for everything else, shares, crypto, you name it, you report it through your normal self-assessment tax return, and that's not due until the 31st of January after the tax year ends. So you've got two totally different processes with wildly different deadlines. It's a real trap.
So let's just break down that 60-day property rule, because it is so important. The second that property sale completes, boom, a stopwatch starts ticking. In that short window, you have to figure out the gain, get onto HMRC's online system to submit the property return, and then pay the tax you owe. It is an incredibly tight turnaround, and it catches so many people by surprise.
And here's a little did you know for you, and it's a really common trap. If you sell a property and you also file a self-assessment tax return for other reasons, maybe because you're self-employed, you actually have to report that property gain in both places. Yep, you heard that right. You do the 60-day online return, and then you have to report it again on your annual tax return. Now, don't panic. You only pay the tax once, but you absolutely have to file it in both places.
Okay, let's switch gears and talk about how to actually calculate what you owe. I know, tax calculations sound scary, but we can turn all these rules into a pretty simple formula.
Now, the absolute key to getting this calculation right is understanding what HMRC calls allowable costs. Think of these as all the expenses you can subtract from your sale price to make your final gain, and your tax bill smaller. So what counts? Well, the original price you paid for the asset, obviously, but also things like stamp duty and the legal fees for both buying and selling. What's really important are the costs of capital improvements, so building an extension, for example. But, and this is crucial, you can't claim for general maintenance, repairs, or just redecorating.
Let's make this real. Meet Lucy. She's an IT contractor based in London, and she's just sold her buy-to-let flat. The sale price was £410,000. Now, when she adds up everything she spent, the original purchase price, stamp duty, legal fees, plus a new kitchen she put in, her total allowable costs come to £280,000. Simple subtraction, right? That leaves her with a total gain of £130,000. From that, we take off her £3,000 annual allowance, which leaves a final taxable gain of £117,000. See? Once you know the formula, it's just a matter of plugging in the numbers.
So the big question, what was Lucy's final tax bill on that? A massive £30,480. Wow. That really brings it home, doesn't it? It shows you just how significant this tax can be and why getting all those calculations spot on is so important.
Right, so we've seen how it works. Now let's talk about where it can all go wrong. We're going to look at some of the most common and costly mistakes people make, and how simple errors can lead to some really big penalties.
Here they are, the top 5 CGT mistakes we see all the time. Number 1, and it's a big one, missing that 60-day deadline for property. 2, forgetting to claim every single allowable improvement cost you're entitled to. 3, just assuming that your main home is automatically 100% exempt. It's not always the case. 4, not reporting your capital losses, which you can use to offset future gains. And number 5, gifting an asset to, say, your child, and having no idea that HMRC sees that as a taxable event. All very easy mistakes to make.
And believe me, these mistakes have real-world consequences. Take Trevor from Leeds. He sold his buy-to-let property and just assumed his solicitor would sort out all the tax stuff. Big mistake. They didn't. 4 months down the line, a lovely letter drops through his door from HMRC demanding £1,200 in late filing penalties and interest. And the worst part? It was a completely avoidable expense if he'd just known the rules.
Okay, enough of the scary stuff. Let's finish up on a more positive note. Let's talk about smart planning and getting expert help, and how you can legally, and that's the key word, legally reduce your CGT bill.
And here's fantastic pro tip for you. If you're married or in a civil partnership, you can transfer assets between each other completely tax-free. So, what does that mean in practice? Well, before you sell an asset, you could transfer it into joint names. That way, you can both use your annual allowance. That's 2 allowances instead of 1, instantly making £6,000 of your gain completely tax-free. It's such a simple but incredibly effective strategy.
And here are a few more smart moves to think about. You could time your sales carefully to spread large gains over a couple of different tax years. Always make sure you're claiming every single relief you're entitled to, like business asset disposal relief, for example. Keep meticulous records of everything, all your costs, all your transactions, and honestly, the most important one, always get expert advice before you sign on the dotted line.
So after all that, how are you feeling about capital gains tax? Let's be honest, it's a pretty complex area of tax, isn't it? The deadlines are super strict and the penalties for getting it wrong can be really expensive. Look, with something this important, you really don't want to leave it to chance. If you're feeling at all unsure, the best thing to do is get some expert guidance. The team at ProTax Accountants are absolute experts in this field. You can reach out to them directly on WhatsApp or give them a call on 07985 689912. Or, if you prefer, just drop them an email at info@protaxaccountant.co.uk. And for more clear, straightforward tax advice just like this, make sure you subscribe to their YouTube channel. Thanks so much for joining us today.